on board Mr. R.S. Gopal Sastry, the Group CFO at Endurance Technologies, to talk about the developments in their business. Mr. Sastry, great to have you today on ET Now. This 318 crore rupees of the raw material cost that was absorbed in Q1 with a pass-through expected in Q2. Tell me more about that, because if aluminum softens further in Q2, will you pass on the benefit then to the OEMs or retain it as margin?
Our pass-through is completely contractual. So we have an agreement with the OEMs to pass it on, all the increases. With some, it is real time. In some products, like in our proprietary products, which is a suspension brakes, it's with a quarter lag. So what we are seeing is, while we have absorbed all the cost in Q1 for the proprietary products, with some customers, the increases happen actually. The average material cost of Q1 becomes the selling price base for Q2. So we will have that, and if there is a softening in Q2, we will have a corresponding reduction in the selling price in Q3 and so on. So it's protected, but it's always a quarter lag. It's more pronounced this quarter because the increase had been very steep. We saw a significant portion of our income rise actually coming from commodity pass-through.
I wanted to address the concerns first. So one more then, your 4 plants which are simultaneously ramping up right now, tell me which one carries the highest execution risk and what is the contingency if the volumes disappoint at all?
So the 4 plants are in their sequence of how we started is the alloy wheel plant. In terms of volumes, we see that in Q3 we'll be reaching peak volume. And our total capacity of 300,000 wheel sets, 250,000 wheel sets in our Chakan and 150,000 wheel sets in Bidkin, both will be fully utilized by in Q3, Q4. So we do not see any risk over there. There are some operational challenges in terms of bringing the profitability back in its ramp-up phase, and we see that there is a very smart progress in that line. The second one, which we went on job 1, start of production, is a battery pack plant. And we see that in Q3, we'll reach peak volumes there too. And that's for the 2-wheeler battery packs, which we are now supplying. And we also made an announcement that we will be commencing production of 4-wheeler battery packs, for which we are in advanced stage of discussions with some OEMs. However, we went ahead and we are beginning to invest on the prismatic battery pack assembly lines for the 4-wheelers. The next one is our plant in Shendra, which makes specialty castings for the 4-wheeler, especially electrical vehicle business and for the export market. We will be starting production of that in September. The peak annual volume based on the orders which we have received now would be 513 crores, and that would happen somewhere next year. Are there any risks over there? Because our investments into these special investments are based on the ramp-up. So we don't see a big risk there. We see that that being highly margin accretive, we are very positive about our aluminum casting plant in Shendra. The last one, which will go on stream, is the brakes plant in Chennai. And already in this quarter, we'll be starting production for Royal Enfield. And the other customers who are in that region are also on, it will happen in the next upcoming quarters. Overall, with that, our capacity for braking systems would become 9 million per annum, and brake disc will become 9.6 million per annum. And with that, the ABS capacities will reach 1.5 million per annum. And we're also starting production for the dual channel anti-lock braking systems for Bajaj for 120,000 this year and another 120,000 next year. So overall, we don't see a big risk in execution. I think all the investments which we have made, as had been the track record in the past, are coming to will be actually safe and actually will yield returns, margin accretive returns to the company.
Mr. Sastry, hi, this is Harsh here. I want to first off take a bit of a step back, look at Q1 numbers. 12.5% is where your margin number lies at. How quickly does it rebound, and by how much in Q2? You suggested the pass-through happens with a quarter's lag.
So we have lined up all the actions for getting the pass-through for all the which we have suffered. There would be a smart uptick I wouldn't be able to quantify it. There would be a smart uptick, but there are also, it's not only the commodity pass-through, quite a few other steps are also being taken in the company to improve the operations and also change the mix positively. So all this will yield good results, and we are very positive, and we are putting the teams are putting their best efforts for FY27.
Around 13.5% odd in terms of the margin number for FY27 full year. Is that probably the better way to look at the situation which is playing out?
This is the interim target for our final numbers, which are there in our strategic plan. And these are the targets we are gunning for.
Very well on the top line. Do you expect that likely to continue? Because one, just the raw material pass-through will happen starting Q2. So that itself will provide a tailwind. And then on top of that, you've done very well for Q1 as well. Is that momentum likely to sustain?
See, qualitatively, if you see, we already have 5,000 crores of orders won in the 5 years. And as of FY26, only 1,100 crores had gone on start of production. And in FY27, we are expecting that cumulative number to reach 2,700 crores. So if you look at the quality of our revenue growth, these are happening with, yes, our our main customer, Bajaj, but they're also happening with all the other products, with all other customers too. And the order books which I just spoke about are from the customers other than Bajaj, which means that our growth is well laid out, and we are expecting growth to be in the same lines and even better.
Now, also, Mr. Sastry, I'm keen to know how Europe is behaving and how do you diversify, right? Because you've clearly got multiple people who you've spoken with, management, suggesting that there is a decline visible in Europe. And there is an uptick likely coming from China. Are you also capitalizing on that? How and how quickly does that play out?
So Europe clearly is now in a situation. So if you look at last year, the quarter we just went by, the registrations grew by 7.4%, but production actually was not growing, which means the demand is being filled by imports into Europe from China. And second problem they have is a lot of these OEMs of Europe actually have a significant portion of sales coming from China. They export into China, and both are not happening. They are at a much reduced state. So there is a stress on the domestic market in Europe, which at least till Q1 we managed to tide over. But we have put in place a significant number of steps to see that we are growing with a lot of OEMs within the volumes they have. So we had all the investments we have made in the past, we will continue to support. And we are also lined up a significant number of inorganic growth steps to see that we are able to capitalize on getting capacities in, also take whatever debit growth of demand as we see it, we should be able to benefit from that. And the last part which you mentioned, yes, as China will start producing in Europe, as of now, they don't do much. They only assemble, or they are only doing some imports into Europe. But as they start producing more in Europe, we will see better opportunities for us. And with some of our directors also very closely connected with the Chinese manufacturing environment. So we are exploring opportunities there too and make the best of that.
Last off, just with regard to, CapEx plans going forward, could you quantify the quantum of CapEx you're doing and what happens to the debt which is sitting in the balance sheet? Are you comfortable with that kind of number? Does anything change there?
So we, both in Europe and India together, we do not have any debt in the books. India, we are cash positive. In fact, despite the aspect that we had to give 318 crores of commodity increase to the vendors upfront, we still managed with a decent positive cash balance in Q1, about 415 crores. So we are not very concerned that we don't have a debt as of now, and we don't have a requirement to borrow, despite pretty elevated CapEx plans as we have. We did 611 FY25, upward of 800 in FY26. FY27 will also be 800. But the quality of CapEx is also changing. We are investing a lot on automation and in system improvement so that we can gain from better operating efficiencies.
Mr. Sastry, so good having you today on ET Now. Thank you so much for your time and speaking with us.